Welcome to today's deep dive. Our mission right off the bat is to figure out how to build a 2026 portfolio that actually survives, what everyone is calling a dangerously frothy U.S. market.
Yeah, and we are essentially acting as your senior portfolio strategists today.
Exactly.
We're taking a massive stack of Outlook reports from Vanguard, BlackRock, Schwab, and UBS, and we're translating all that into a very specific game plan.
Right, like why you desperately need international exposure right now and exactly which low-cost funds will actually get you there.
Yep.
But before we get into all the heavy microeconomic data, imagine for a second that you are standing at the entrance of a massive, sprawling supermarket. You've got a cart, you have budget, and you're ready to stock up for the long term.
Okay, I'm picturing it.
But there's a catch. You are only allowed to shop in aisles 1 through 4.
Wow, okay. That is a severely constrained diet.
Right.
I mean, you can get the essentials in those first 4 aisles, your bread, your milk, maybe some cereal. You are surviving.
Sure, you won't starve.
But because you are completely blocked off from the international foods, the fresh produce at the back, the bakery, you certainly aren't getting the optimal nutritional mix to actually thrive over a lifetime.
And that restricted supermarket run is exactly what millions of investors are doing right now with their retirement accounts.
Yeah, absolutely.
We have had such a dominant run here at home that people have developed this severe home bias. But let's look at the actual math from the data stack in front of us.
Let's do it.
U.S. equities currently account for roughly 58.3% of the global equity market. Think about what that leaves on the table.
That's massive.
A purely domestic portfolio leaves over 40% of the global opportunity set completely untouched.
Which is an enormous blind spot, especially when you look at the underlying health of that U.S. 60%.
Yeah, break that down for us.
So if we pull from Vanguard's 2026 economic and market outlook, they present a really fascinating dichotomy. They do see about a 60% chance that the U.S. economy achieves a solid 3% real growth rate in the coming years.
Which sounds great.
It is. And a lot of that is driven by massive corporate investments in artificial intelligence and, other technological shocks.
Let me stop you right there, though.
Yeah.
Because if there is a high probability of solid growth driven by AI, why would I want to leave that market?
Right. It's counterintuitive.
I mean, that sounds like exactly where I want my money to be.
You'd think so, but it comes down to how markets price in expectations. Growth is great, but Vanguard explicitly warns that U.S. markets are currently highly concentrated and frothy.
Frothy.
Yeah, frothy. The future potential of AI, the anticipated productivity gains, all of that is largely already priced into the current valuations of those tech companies.
And I see.
You are paying a massive premium for growth that hasn't even happened yet.
So they have to be perfect.
Exactly. If those companies execute perfectly, they just meet expectations. The stock price might not even move much. But if there's even a slight stumble,
then the bottom falls out.
Right. The downside risk is significant because the stock is priced for perfection.
So frothy essentially means dangerously expensive and fragile.
Very fragile.
So we are looking for a shock absorber. And this is where the sources talk about imperfect correlations.
Yeah, and that is the mechanical benefit of stepping outside your home market. The U.S. equity market historically has about a 0.72 correlation with international markets.
Okay, so meaning they don't move in perfect lockstep?
Correct.
Because a correlation of a flat 1.0 would mean two markets move exactly together, mirroring every high and every low.
Exactly. So a 0.72 means they are certainly related. They're both equities, obviously, but they maintain a level of independence.
And that independence is the cornerstone of portfolio defense.
It really is. Because they don't move in perfect tandem, adding international stocks inherently reduces your portfolio's overall volatility.
Makes sense.
When the U.S. market zigs downward, the international market might zag upward, or at the very least, it might zig downward with much less severity.
You're smoothing out the ride.
You're smoothing out the ride, exactly.
There's an example in the research that brilliantly illustrates why this matters on a highly practical level.
Oh, the 2010 BP oil spill.
Yes. We all remember the environmental catastrophe, obviously, but the financial fallout was an absolute masterclass in why concentration risk is terrifying.
It really was. The impact on British pensioners specifically was devastating.
Right, because BP is a multinational company, but its largest market cap concentration was naturally in the United Kingdom.
It was a huge cornerstone of the UK stock market at the time.
So a British investor holding a purely domestic equity allocation was disproportionately affected by the collapse of just this one single security.
Yeah, their entire retirement was severely dented simply because of BP's massive weighting in their home market.
It proves you just cannot let your financial future hinge on one localized disaster.
No, you can't.
But let me play devil's advocate here for a second,
Yeah.
because I look at my own portfolio and I think, well, wait, I own U.S. tech giants.
Yeah.
I own the company that makes the world's most popular smartphone. They sell those phones in Europe, in Asia, in South America. The search engine I own is used globally.
Right, the classic argument.
Right, if these American companies are doing business everywhere, am I not already globally diversified just by holding them?
It is honestly the single most common assumption investors make to justify staying in those first four supermarket aisles.
And you're going to tell me it's wrong.
It is fundamentally flawed. Yes, U.S. multinationals generate revenue globally, but relying on them as your sole source of international exposure leaves you dangerously exposed to massive sector concentration.
Okay, walk me through that. How does owning a global phone company create a sector problem?
Because if you buy the U.S. market today, you are buying a market that is incredibly top-heavy. It is entirely dominated by technology and consumer discretionary stocks. By contrast, if you look at international markets, they have much heavier weightings in completely different sectors. We're talking industrials, materials, massive financial institutions.
Okay.
So by skipping international stocks, your sector exposures are completely skewed compared to the broader, balanced global economy.
You just totally unbalanced.
Exactly. You completely miss out on the dominant semiconductor manufacturers based in Europe or the massive mining operations in Australia.
So you don't actually own the global pie.
Yeah.
You just own the American tech-heavy slice of it.
Precisely.
Okay, so we need to leave the U.S. to avoid that sector concentration and to capture the other 40% of the world. But the moment we cross borders, we have to confront the elephant in the room.
Foreign exchange rates.
Yes. What happens when I buy a European stock and the euro tanks against the U.S. dollar?
This is the currency wild card. And it's huge. When you buy a foreign asset, you are actually making two separate bets, whether you realize it or not.
Too bad.
Two bets. You are making a bet on the underlying company's performance, obviously. But you are also making a bet on the currency of the country where that asset trades.
Ah, okay.
And those currency movements can act as massive tailwinds pushing you forward or brutal headwinds holding you back.
The UBS study in our stack makes this incredibly concrete. Let's look at the period between late 2022 and late 2025.
Okay, good example.
During that window, the U.S. dollar was actually weakening against currencies like the euro and the British pound.
Right.
So for European investors who were holding U.S. stocks, that weakening dollar was a nightmare. Even if the American company's stock price went up, the European investors saw their returns shrink when they had to convert those weakening U.S. dollar gains back into their much stronger home currency.
Exactly. But if we flip that perspective for the listener, assuming you are investing with U.S. dollars, a softening U.S. dollar is actually a massive advantage for your foreign assets.
Because of how the conversion works.
Right. Think of the mechanics. When your international investments appreciate and the foreign currency they are denominated in strengthens against the dollar, those gains get a secondary boost.
Wow.
Yeah, when you convert them back into your native currency, the weak dollar makes your foreign returns look even better on your brokerage statement.
Which brings up a really technical point in the research that I want to unpack. The sources mention funds that hedge against this currency risk, but they throw around jargon like forward contracts and cost of carry.
Ooh, the financial alphabet soup.
Yeah, put that in plain English for me. If a weak dollar is good for me, why would a fund try to hedge against currency movements at all?
So hedging is basically an attempt to remove the currency variable entirely, so you're only betting on the stock itself.
Okay.
But to do that, the fund manager has to essentially buy insurance. They use those forward contracts you mentioned, which are basically agreements with massive global banks to lock in a specific exchange rate for the future.
But the banks don't do that for free, I assume.
Absolutely not. It costs money. And furthermore, because interest rates in places like Europe or Japan might be lower than U.S. interest rates, there is an ongoing cost to maintain those contracts.
Which the industry calls the cost of carry.
Right, the cost of carry. And all of this slowly eats into the fund's returns.
Okay, so currency hedging is basically like buying travel insurance for your portfolio.
I like that.
It protects you from a sudden catastrophic disaster in the exchange rates while you are overseas, but paying the premium for that insurance ultimately drags down your overall returns if nothing goes wrong.
That is a remarkably accurate way to look at it. Over the long term, Vanguard's research shows that for equities, currency volatility tends to just wash out.
It just reverts to the mean?
Exactly. It fluctuates, but it reverts to a mean. So paying that continuous travel insurance premium is a massive drag.
Right.
The hedging effect is relatively marginal, and in environments with a softening dollar, it actually reduces your upside.
So skip the travel insurance if you are investing for the long haul. Let the currency fluctuate.
Yeah.
Which brings us to the second massive catalyst for why 2026 is the perfect moment to exploit international markets.
The valuation gaps.
Yes, the valuation gaps.
This is where we look at price to earnings, or PE ratios. For anyone unfamiliar, this is simply the price you're willing to pay for $1 of a company's earnings.
We already established that the U.S. market is frothy.
Very, but when you look at the international data, you see a completely different landscape.
The numbers are wild. Look at Vanguard's broad ETF, Total International Stock ETF, ticker symbol VXUS. Its PE ratio is hovering around 17.5.
That is fairly reasonable.
Right. But then you look at a value-focused fund like the Vanguard International High Dividend Yield ETF, ticker VYMI. It is sitting at a bargain PE of just under 14.
13.9, yeah. So if we pull all these macroeconomic threads together, you have a softening U.S. dollar providing a currency tailwind combined with international PE ratios that are deeply discounted compared to the U.S. market.
It's a perfect storm.
It really is. International dividend and value stocks are offering a fundamentally sound alternative to expensive U.S. growth stocks right now. You are buying robust, established cash flows at a steep discount.
Okay, the macroeconomic theory is ironclad. We understand the why, we understand the currency mechanics, and we understand the valuation gaps.
So what's next?
Now let's translate this theory into action. Let's figure out how to navigate this maze of tickers so we don't end up holding the bag if the U.S. market stalls.
Let's do it.
It is time to look at the top 5 low-cost international ETFs for 2026. And a quick note, all of these have expense ratios under 0.15%, which was our strict cutoff for cost efficiency.
Crucial cutoff.
Let's start with what I call the broad market twins.
Ah, you are referring to VEA, the Vanguard FTSE Developed Markets ETF, and SCF, the Schwab International Equity ETF.
Those are the ones.
Both of these funds are philosophically identical. They seek to capture the developed market outside the U.S. We are talking about established economies, Japan, the UK, France, Switzerland.
And they are incredibly cheap. VEA has an expense ratio of 0.05%.
Practically free.
And SCHF is at 0.06%. You are paying pennies to hold thousands of global companies. And their performance over the trailing one-year period was nearly identical, both posting returns right around 29%.
Which is fantastic. But the crucial data point here is actually their correlation to one another.
Oh, really?
Yeah, it is almost a perfect one-to-one. It's a 0.99 correlation. They move in near-perfect synchronicity because they hold largely the exact same underlying assets.
Okay, hold on. If these two funds are practically identical twins, how am I actually supposed to choose?
Right.
And more importantly, how do I avoid turning my portfolio into this complicated mess of overlapping tickers? Do I buy half of VEA and half of SCHF?
Absolutely not. And I'm glad you asked, because this raises a critical point about portfolio construction. More tickers do not equal more diversification. Most long-term investors only really need 3 to 5 ETFs in their entire portfolio.
Wow, really? Just 3 to 5?
Yep. The optimal strategy here isn't to buy all the funds on our list. It is to use a core and satellite approach.
And satellite.
You select one broad market international fund as your massive core anchor, and then you pair it with a smaller targeted satellite fund to capture specific themes.
Oh, I see.
So between VEA and SCHF, you literally just pick one based on whichever brokerage platform you prefer and ignore the other one.
Oh, okay. That simplifies things immensely.
Yeah.
So VEA or SCHF could be my core. Or, what about the own the world option? VXUF, the Vanguard Total International Stock ETF.
Yeah, VXUS is arguably the ultimate core holding if you want a truly global footprint.
Because it holds everything.
Right. The difference between it and the twins we just mentioned is that VXUS doesn't just hold developed markets, it also includes emerging markets like India and Brazil.
Okay.
It contains nearly 9,000 stocks.
Almost 9,000 companies in a single ticker.
8,691 to be exact.
And the fee is a tiny 0.05%. Plus, it boasted a nearly 40% one-year return recently, 39.6.
It's a monster.
So if VXUS is my massive, broad core holding the entire world outside the US, what is my satellite? How do I target those cheap PE ratios we talked about earlier?
That is where you look at the high-yield value plays. Let's break down VYMI, the Vanguard International High Dividend Yield ETF.
I love the mechanics of this one. It only holds about 1,500 stocks, so it's much more curated than VXUS.
Very curated.
It filters specifically for companies paying higher than average dividends. It costs slightly more at 0.07%. But the performance is just incredible. It recently delivered an annual return north of 45%.
45.5.
But you have to explain why it's overperforming. What are the actual themes driving that?
Well, what's driving that outperformance is its specific geographic and thematic exposure. VYMI has very high exposure to Europe, around 44%, and Japan at roughly 14%.
Okay, let's take Europe first.
So, following the massive energy shocks over the last few years, Europe was basically forced to undergo a structural pivot.
Right.
We are seeing unprecedented infrastructure spending and massive capital flowing into heavy industrials and green transition projects. VYMI captures the established European industrial giants that are actually executing those contracts.
That makes total sense.
Plus,
And what about Japan? I read the phrase Japanese corporate governance reforms
Yeah.
in the reports, which sounds like an absolute snooze fest.
I know, it really does.
How is a governance reform driving a massive value play?
It sounds dry, but it's actually the biggest financial shakeup in Japan in decades.
Really?
Yeah. Historically, Japanese companies were notorious for hoarding massive piles of cash and basically ignoring their shareholders.
Okay.
Their stocks traded at incredibly cheap valuations because the market knew investors would never see that cash. But recently, the Tokyo Stock Exchange implemented a name and shame policy.
Name and shame.
Literally, they essentially threatened to delist companies that consistently trade below their book value.
Wait, so the exchange basically put a gun to their heads and said, unlock the value or get out.
Precisely. And the result has been this tidal wave of stock buybacks and newly issued dividends. That hoarded cash is finally flowing back to shareholders.
Wow.
And a fund like VYMI is perfectly positioned to scoop up those newly unlocked Japanese dividends.
That is fascinating. So you pair the broad VXUS as your foundation, and you add the targeted VYMI satellite to tilt your portfolio toward those juicy dividends and cheap valuations,
Exactly.
capitalizing on European infrastructure and Japanese reforms without completely abandoning the broader global market.
That is exactly how a senior portfolio strategist builds an allocation. But there is one more satellite option we really must discuss, particularly for investors who are focused on defense.
SCHY, the Schwab International Dividend Equity ETF.
That's the one.
It has a slightly higher fee at 0.14%, but it offers a very solid yield of over 3.3%. However, the reports highlight that the real selling point here isn't actually the yield, it's the downside protection.
Right, because when you are assessing risk, you have to look beyond just the raw returns. You have to look at maximum historical drawdowns.
Which is a measure of the most a fund has ever dropped from its peak to its lowest trough, right?
Exactly. SCHY is engineered with a strict quality filter. It doesn't just look for high dividends, it looks for companies with the financial health to sustain those dividends during a full-blown crisis.
Right.
As a result, its maximum historical drawdown sits around negative 24%.
Which hurts, obviously.
Sure, no one likes a 24% drop, but
Yeah.
the context matters. The data compares it to a direct competitor, Vanguard's VEGI, which saw a maximum drawdown of negative 31% during a similar stress period.
Wow. A 7% difference in a massive portfolio is a lot of money.
It is the difference between staying the course and panicking and selling at the bottom. So if you are an investor who gets a little seasick during market volatility, SCHY might be your preferred satellite over a more aggressive value play like VYMI.
Makes total sense. But before we send everyone off to reorganize their portfolios, we have to talk about the tax man.
Oh, yes, we do.
BlackRock's report includes a very stark warning regarding foreign withholding taxes. And this is something literally nobody talks about.
It is a critical, often overlooked drag on performance, particularly for dividend investors. When an international company pays a dividend, the country where that company is based wants its cut.
Of course they do.
They will often withhold a percentage of that dividend for local taxes before the money ever even leaves their borders to reach your ETF.
So my dividend is basically driving down the highway, and before it even crosses the border, a foreign government drops a toll barrier and just takes 10% of my cash.
That is exactly the mechanism. The weighted average foreign withholding tax rate for international stocks is often over 10%. Your dividend gets a haircut before you even see it.
Ouch.
Now, depending on what kind of account you park these ETFs in, whether it is a standard taxable brokerage account or a tax-advantaged retirement account like an IRA, the U.S. government has very different rules.
Right.
In a taxable account, you might be able to claim a foreign tax credit on your U.S. taxes to offset that toll booth fee. But in an IRA, you might just lose that withheld money entirely because the account is already tax sheltered.
Oh, wow. It is highly complex, but the bottom line is that international dividends suffer from tax drag. You must consult a tax professional to ensure you hold these specific high dividend funds, like VYMI or SCHY, in the most tax-efficient account possible.
Definitely. Don't let the toll booth eat your returns.
Don't let the toll booth eat your returns. I like that.
It is all part of optimizing the strategy. You want the global exposure, but you want it structured intelligently.
Absolutely. So let's do a quick, punchy recap of the master plan we just mapped out.
Sounds fair.
First, the U.S. is not the whole world. You're ignoring over 40% of the global market and risking massive sector concentration in tech if you stay home.
Right.
Second, a softening U.S. dollar is making international valuations highly attractive right now.
Yeah.
It acts as a massive tailwind for your returns if you leave it unhedged. And third, you can capture this growth and these incredibly cheap PE ratios using a core and satellite approach. Grab a broad core like VXUS and pair it with a targeted satellite like VYMI or SCHY to capture European spending and Japanese reforms, all for an expense ratio well under 0.15%.
It is a strategic necessity for 2026. You cannot rely on the momentum of the past to secure the returns of the future, especially when the domestic market is so obviously priced for perfection.
Which brings me to a final historical reality check for you to mull over. We mentioned earlier that U.S. equities currently make up about 60% of the global market.
Right.
And it feels like it has always been this way, right? Like American companies have always just ruled the world. But that dominance is actually a very recent historical trend.
Oh, very recent.
If we look back to the 1980s, the U.S. made up as little as 29% of the global equity market.
Yep, the rest of the world was driving the bus.
So here's my question for you. If the past decade belonged almost exclusively to the U.S., how well is your portfolio prepared if the next 10 years belong to the rest of the world?
That's the million-dollar question.
Are you still going to be wandering around aisles 1 through 4, wondering where all the good stuff went? It might be time to take your cart and explore the rest of the store. Thanks for joining us on this deep dive.